Welcome back to Real Estate Radio TV, the commercial real estate focused media for a new interview. In today's interview, we have the great honor to welcome Jeremy Rolf, a broker associate at Mid Valley Financial, a commercial real estate private lender based out of California. In today's interview, we're going to discuss many different interesting topics, including private lending reinforcing itself as an alternative source of financing as banks are tightening their lending capacity, what benefits private lenders can bring over traditional financing, if it is suitable in today's economic and real estate environment, and also investing in the private lender space to optimize your risk-adjusted returns. Jeremy, how are you today?
Hi, I'm doing well. Thank you.
It's a pleasure having you on, and I'm sure we're gonna have a very interesting discussions. But before we diving into all the great topics we've planned for today's interview, I want you to give us and our listeners a brief business background of yourself, and also kind of present us Mid Valley Financial, the type of operations that you're carrying out in the real estate sectors in terms of investment in lending, so we can get a good understanding.
Yeah, sure. Well, my name is Jeremy Rolf. I'm with Mid Valley Financial. I've been in real estate since 2014. My grandfather was a private lender, so I got involved in the industry sort of by proxy, and started off with residential mortgage, moved into private lending, and now private lending for commercial properties as well. So I do agricultural, commercial, industrial, and even residential for business purpose. So that's what I do. Mid Valley Financial has been around since 1985, and we've focused on private lending for our clients. And so, yeah, that's what we do.
Well, thank you for this presentation, and really lending in general. When we see traditional financing with the capital markets, it's been very complicated those past couple of months between the high spike in rates, but also we've seen tightening in banks' lending capacity. We've seen the regional banks, what happened there, where most of the commercial real estate is actually financed by regional banks. So, from this perspective and taking all that into consideration, have you seen the private lending space grow over the span of the past couple of months in commercial real estate?
Yeah, I think the growth has been huge, especially over the last year. Um, you know, but I don't think that it's, um, the banks are always going in and out of the market for loans that they can do. Some will have, too much of a particular property type in their portfolio. Some won't do gas stations or hotels, hospitality, others will. So it really depends. Banks are always moving in and out of the market, like I said. So in the event that, a bank can't do a deal or won't do a deal, private money will. And so it gives a good resource to people who, are turned down by banks, even though that they, as the borrower, might be a good credit risk, or the property itself might be a good credit risk, but maybe the property is not stabilized. Maybe it needs to be leased up. Maybe it doesn't have enough cash flows to qualify for a bank program. And so if the borrower isn't bankable yet, or the property itself isn't bankable yet, or if the borrower just needs to close really quickly and doesn't have the time in their escrow to wait for a bank program to close, then private money is a great alternative.
And you've been in the game of private lending, we could say, for a very long time, and you've acquired some experiences over the year. But truly, with what happened over the past year, have you seen an increased momentum from various type of real estate operators, syndicators, private investors, calling you and seeing ways to face the challenges that we're seeing in the banking system at this time?
Absolutely. People, will go to a bank usually first to see, what the bank can offer them for their deal. And, as banks are tightening their lending standards, LTVs are going down. There's more opportunities to, refinance these properties with private money, or to basically, what I would say is make sure that, the deal gets done. Because what private money does is it gives people a runway of time to get their deal stabilized. So to get in there and get those apartment units leased up, to get in there and get the cash flows where they need to be for the statements. Whatever the case is that the property needs to be stabilized in some way, private money is great for that. And in this era where, banks are, really getting tight on everything, it just opens up more opportunities for people to do their deals with private money, get the deal done, and then 2 to 3 years later, whenever they're ready, and they have some good tax returns to show, some good cash flows to show, then they can refinance into a bank program. So it works out really well because it's sort of like recycling money. People, are moving from a higher interest rate, that usually comes with private money, to a lower interest rate that comes with a bank program.
And so really, if I understand, on one side, of course, that private money lending can offer more options, but also sometimes it's seen as a more costly solution than traditional bank financing. So really, apart maybe from the LTVs, what are the other benefits that private money lender can bring to the market that traditional banks cannot, such as more flexibility, less covenants? I mean.
Mm-hmm. Yeah, so private money, we kind of like to say when banks say no, private money is the only way to go. And because when a bank says no, what options are you left with? Private money steps in, gives them the speed that they need to close quickly and the certainty of execution, knowing that your loan will fund if we say it will. And that's simply because with private money, we're taking less risk to an extent. We're offering lower loan to value ratios. So usually we're capped out at about 65% loan to value. The other thing is with private money is it carries a higher interest rate usually. So typically, these days we're in the 10 to 12% range on a first position note. But what I tell people is you have to remember that those payments are interest only. And so your monthly payment is going to be, lower with just paying interest only. But it helps you because it gives you the time that you need in order to stabilize that property. And like I was saying, fix it up, get tenants moved in, get it fully stabilized so it's showing some good cash flows. And once you have that, then you can apply, for a bank program and put in that permanent financing. So private money helps with a lot of things. There's not, how would I say, you can do things a lot quicker because we're not, submitting the, project to a big loan committee. There's no limit on the amount of deals that we can do of a particular type. because we fund all of our loans off of our own balance sheet and sell them off as fractionalized shares to investors later. So there's really no limit to the amount of loans that we can make to any one party, any one property type. So it gives people a lot more options, whereas a bank will have those limits, and they will have to submit the deal to a loan committee. They're going to analyze their portfolio and see, okay, how many more of these types of loans do we want in our portfolio? What's our risk profile? And how many more of these property types do we want in our portfolio? So a bank has a lot of money to lend, but they also have quite a few restrictions that people who otherwise would be able to be lendable and be a good credit risk are not getting their deals done simply because of parameters that are outside of their control with the bank. And private money, you don't have any of that. That's why the main driver of people to use private money is certainty of execution, knowing that their loan will fund, and also the speed of execution. There's not as much due diligence that we need to do, but remember, we're also not taking as much risk. We're usually, like I said, our LTVs are capping out about 65%. So that's what I would say are a couple of the benefits of private money. Basically, people want to get into it when a bank's going to say no, they need to get their deal done anyway, or they need to move quickly. No muss, no fuss, just let's get the loan done, and that way they can get into their project and start working on it.
And I mean, over the past couple of months, and now it's been almost, I would say, 6 to 8 months when we've seen, rates starting to increase, and that has created a true disparities between buyers and sellers' expectations. At least we've seen, rates grow higher than cap rates decompress. So based on today's environment, do you see a lot of deals suitable to go to the private money route despite, the higher cost of capital it can bring? I mean, what are your thoughts on that perspective?
Yeah, absolutely. LTV ratios are going lower, so people are not using as much leverage, right? It's, sort of like a teeter-totter where, people, if interest rates are low, they're probably going to be able to use more debt to fund their deal. When you use more debt, you don't have to give up as much equity. The equity investor takes more risk. And so entrepreneurs, what they might be doing is bringing on more equity investors to, make up for the funding shortfall that would have been there, otherwise, whereas before maybe, people were going as high as, say, 75, 80% loan to value, for a loan. Now we're probably at 55 to 60, depending on the property type. And so people are using less leverage, which is making their deals less profitable. But, people still need to do deals, and it's just changed the way that they fund them, that it's changed the structure of their capital stack. Whereas, before, more of their capital stack would have been debt and a little bit of equity. Now their capital stack has to look like a lot more equity and less debt. So, but that's normal. It's just natural ebbs and flows of the economy. Deal making activity goes up when interest rates are low. People employ more leverage, and they, realize, greater returns on equity usually. But remember too that, when people, are using less leverage in the future, here, their deals are actually stronger. And sometimes people are seeing, for example, that an interest rate that they locked in at 3% a few years ago has benefited them by being able to get in the deal and stabilize the property and start to realize some income and some growth. So there's a lag time, there's a delayed effect. But ultimately, I think that no matter what, a good time is, it's always a good time to invest in real estate. Because now that the capital stack has shifted a little bit and people are bringing in more equity, but I think it's actually making their deals stronger. So it's just changing, the way you have to capitalize your deal. Before you would have to convince a bank to lend you more money. Now you have to convince an investor to bring in more equity,
And
so, yeah.
go ahead.
Yeah, so it's just the nature of things, but I don't think it's bad. I think that you can get a great deal on property today just as easily, depending on how you buy it. And so yeah, it's always a good time for private money or real estate investing. It's just a matter of, structuring your deal the right way to take advantage of market conditions.
And when getting insights on real estate, I believe it's really crucial to talk to lenders like yourself, because you guys are really at the forefront of the capital stack, like you mentioned. And oftentimes, investors, when they're in a distressed position or need to refinance an asset on a somewhat distressed basis, you guys are the first one that investors go and see. And so I really want to get your insight, because a lot of people say that we're going to see a lot of distress opportunities coming to market, a lot of opportunities coming to market in general. So Jeremy, I want to get your thoughts on that. Where do you see the market, of course, if we don't see any other major financial changes happening again?
Mm-hmm. Yeah, lots of opportunity all around. I mean, agriculture, there's going to be a big opportunity with shifting of prices of different commodities. Certain agricultural land may not be as valuable, or have a little difficulty refinancing, perhaps. We see it in the commercial real estate sector with the office space. I think a lot of people right now feel that office is particularly concerning, but, I think that the wise ones out there realize that each deal has to be evaluated on a case-by-case basis. Is office bad right now? Well, if a building has, a national law firm that has signed an agreement to occupy the building, with no covenants that could get them out of the deal, then that could be a really great deal. It's case by case, because there are still people going into the office, and there are still really great office deals out there. Same thing with agricultural, same thing with industrial. I think, self-storage and manufactured housing communities have gotten a lot of attention recently, especially because people are really waking up to the fact that these asset classes performed really well in a recession, or, market disruption like what we had with COVID-19. And so, even in those spaces where, there's a lot of interest, there are still great deals to be done. There are still a lot of deals out there that are not that good, even though the asset class is very favorable right now. So it really does depend on the deal itself and how the entrepreneur is structuring their deal to make it pay off in the long run.
All right, so it's really case by case, and I believe, based on our conversation, that's really where a private money lender can come into the situation, because, like you mentioned, oftentimes we see banks having general guidelines in terms of we're not investing in that asset class anymore, and that's where if it's a great deal, private money lender can come in the capital stack.
hmm Yeah, and the other thing is a private lender can really be your best friend as a real estate entrepreneur because, a lender is looking at the deal through the lens of, am I going to get my money back? Before we have a return on capital, we have to have a return of capital. And so if you think about the interest rate that you're paying a private money lender, let's say it's 10%, just to use a round number. Well, that interest rate, 10%, is the only thing that the lender is going to participate in. It's the only upside that the lender is going to participate in. If you take a property and triple the value of it, you're going to see the benefits of that, but the lender is not. So what is the lender looking at? The lender's looking at your deal from the lens of, am I going to be okay? Is this deal going to work? And if it's going to work, then that's all we care about, because we don't share in any of the upside. The equity investor shares in all of the upside. So if you take that property and you increase the value by 3x, you see all the glory from that, right? So, real estate investors, they get excited about that. They want to participate in the equity side. But what you have to keep in mind too is that when you're on the equity side and you're making those higher returns, the reason why you're making those higher returns is because you're taking more risk. The project could fail. There's a lot of things that can go wrong. It could go not as much to your liking as you thought it might. And so there's a lot more property management that has to be involved. You have to manage tenants. You have to manage, different things with the building. And so there's a lot of more work involved on the equity side. The returns are higher, but the risk is also higher that it may not work out. So it's really nice to evaluate your deal from an equity perspective, but from a debt perspective, what the lender's looking at is really sort of being that backstop into making sure, like, hey, is this deal viable? Is it going to be okay? So it's sort of like that saying goes, where protect the downside and the upside will take care of itself. And that is really indicative of how we look at things as a lender. We're going to advise the borrower on, hey, these are the downside risks that we see, and they may be able to tweak some things or reevaluate their business plan in order to make it more successful. So a lender can be really helpful in those ways,
And now switching gears, because we've talked about the benefits of private money lending from an investment, from an equity perspective, but private credit and private money lending, which is part of private credit, has been growing a lot as an asset class over the past couple of years. There's been a recent study done by Goldman Sachs on family offices saying that a lot of family offices were looking at allocating more capital into private credit, and now that we're entering in the double-digit type of returns for private money lender, you can see them as a pretty interesting type of investment. So, really, what is your perspective on that to really maybe optimize your risk-adjusted returns to invest as a private lender, either directly on deals or either through experienced people like yourself?
Yeah, it's a great opportunity for investors who, want to be the bank. They want to collect mailbox money. They want to literally do nothing and get a check every month. And private money works great for that. If you're talking about a loan that the investor is going to get 10% net return, on a loan that's collateralized by real estate, and you don't have to do anything. You don't have to manage tenants, termites, toilets, all those kinds of things. It's a great thing. And so for people that are, nearing retirement age and they, are particularly concerned or interested in generating income from their investments, private money is phenomenal for that. And it's really only grown more over the years. I mean, private money is nothing new. It's been around for many years. I think that people are, new generations are waking up to it, and there's more attention going to the space now, but it's always been available. I think now technology has allowed a lot of private money lenders to up their game, service their borrowers even better, service their investors even better, and it's a wonderful thing because these individual investors are people just like you and I that want to make a return on their money, and they want to make high yielding loans for a short period of time, backed by a secure asset like real estate. It's phenomenal, and so that's why you've seen the interest from different investment managers, asset managers, funds that are coming into the space, and sort of getting into fund these loans, which even now a lot of it is done with individual investors, just that people that private money lenders know. So and we always need more money to lend. So it's kind of it's been a great opportunity for a lot of investors, investment funds to come into the space and start to realize some really great returns by supporting liquidity into the system and funding loans for real estate that otherwise wouldn't have gotten done.
Well, thank you, Jeremy, for coming in and really diving into the private money space, both from an investment perspective and also a lending perspective. Before we let you go, is there maybe anything else we haven't touched on, we haven't mentioned that you wish to mention to our audience before we let you go?
Well, just that, I would say talk to the private money lenders in your community. As a real estate investor, these are tools for you. And so just like anything, you want to have a great real estate agent that you trust that can help you negotiate the finer points of the deal. You probably want to have a great real estate attorney that you could call on at any given time. And you definitely want to have a good banker to discuss things with. And you also want to have a great private lender to discuss things with, because, the world is built on relationships. I mean, like it or not, social media, podcasts, email, all these things are wonderful communication channels. But there's really I would say the fine line of what gets deals done is those who have relationships. And so you want to build relationships before you need them. And having a good private lender, having a good appraiser, all these people that are involved with your particular real estate business, you want to know these people and you want to start building relationships with them now, so that when you have deals coming to show them that you've already, kind of established a rapport. I find that is the difference in success between the professional real estate investors and the amateurs. Is the professionals understand relationships, they understand financial analysis, and they're prepared ahead of time, so that way when they need someone like a private lender, they have someone they can call already. So I would say to all of you out there, in your local community, get on the phone with a couple private lenders, interview them, ask them some questions, how they do deals, what they're considering in terms of risk and why, and what they're not. And that could be a really great source of insight for you.
No, it's truly important to really build your network, and I would say that real estate is truly a team sport, because If you want to move forward from a sourcing perspective, from a lending perspective, from an equity perspective, you got to build those relationship, and relationships do not build in a day. Like you said, if you wait until you have a property to call your lender, it may be complicated, right? But if you start building a relationship ahead of time, it's really key to being successful in the space and having an edge against other investors. Jeremy, thank you for being on our show. We'll make sure to put all your links and contact information in the bio of this interview. So if people ever want to reach out, they can. It's been a great pleasure having you on, guys. You can make sure to download our app. That's free and available both on the App Store and Android. And talk to you guys soon.
Yeah, thank you so much.
You're welcome.